ahead on Money Life.
We obviously had the April tariff crash, but since then it has been very smooth sailing in a pretty low volatility environment. So I'm going to say that the first half of 2026 probably more volatile than the second half of 2025 has been. But again, I mean, I don't think you want to get bearish when all those incredibly cyclical groups are the ones making new highs.
That is Scott Brown, Chief Strategist at Brown Technical Insights. And yes, he's here talking technicals. And while he thinks seasonal impacts will be good for the market now, he'll also say they may not be so good for the market next year. But speaking of seasonal impacts, Jeffrey Hirsch, editor at the Stock Traders Almanac, returns to talk about the Almanac for 2026. That's our book interview. And in the market call, David Rosenstock, Director of Investments and Financial Planning at Wharton Wealth Planning. He'll be here talking mutual funds and ETFs.
Make it so.
Yeah, hard to make it so. The show's up a little bit late. It is totally my fault. I cannot blame anybody else. It's just on me. Super busy, which has been just kind of brutal as we're getting to the holidays, but the holidays always a busy time, particularly busy right now because, well, there will be some childcare involved in my life. Now, it's not my children themselves. It is my grandchild, my grandson, Declan, who we are heading down to see. Gail's actually going down a few days before I will, but we'll be recording the show differently next week, and there's a bunch of other things and a lot of moving parts and a lot of stuff when I'm going away. Like last night was a lacrosse night with the Boston Box Lacrosse League, which I own, but obviously there are things that have to be taken care of when I'm going to be away. And so I've been trying to get that done as well so that things can there run smoothly while I'm gone. So a lot of different moving parts. That's why the show's been late the last 2 days. I hope we can stop that, but that's all on me. I cannot blame anyone else, much as I wish I could. What I can be responsible for as well is the fact that we've got a great show for you, and we try to do that every day, and I think we've achieved it again for you today. We got Scott Brown talking technicals, Jeffrey Hirsch talking the Stock Traders Almanac. He was, of course, here yesterday talking some technical analysis and seasonal impacts and more. But, you know, it's interesting because here we are talking about the Stock Traders Almanac, which is a book, right? And we'll talk about what you can do with older technology and that sort of stuff, but we're talking about it the day before the Fed meets. And you might think, oh, isn't there going to be a lot of Fed news? Not necessarily here because a lot of it's priced in and because we're not that focused on the day-to-day. It's easy to go down that rabbit hole. And we understand that you want to be informed and we try to do it. But it also is something that's important to us to not get too involved because we'd like the shows to be able to last for more than a few hours, right? The show itself is 1 hour of financial talk, but if we talk only about the Fed, we might be in a situation where if you're catching up, you'd be like, oh, do I need to listen to this one? You missed a day and now it's tomorrow when the Fed news comes out. So we try not to be too much on the day-to-day. We also do try to let you know what's going on with taping elements and timing elements when they become relative and relevant to the interview. In other words, if we're holding an interview, you'll hear us say something like Todd Rosenbluth and I, most of the time we tape on Tuesdays. You'll occasionally hear him say, hey, as we tape this is where the statistics were. And I'm less worried about, oh, this fund is up 22% for the year and 2 days might make it 23% or might make it down to 21. I'm much less worried about that than I am about timing elements where somebody is talking about the Fed and then maybe the Fed has a surprise and we held the interview and now the interview's not worth as much. We don't think that happens very often. It's been interesting doing some writing for TheStreet.com where they have been holding some things, or there's been some things where they couldn't get them on. And I've had one or two cases where I've gone back to our source on a story and said, hey, you should be aware, we wrote this up. I don't normally send it to somebody pre-publication, but I want to make sure that you still feel all your comments hold. And they've invariably come back and said, oh yeah, they're still good. Like that interview could have been done yesterday. There you go. That's part of what we want as well. But you should let us know what we can do to make this show better for you because we'd be happy to do something if we could. So Chuck at MoneyLifeShow.com is how you reach me. As a reminder, today is the last day of our contest. So you got a few hours, even though I'm late getting the show up, you got a few hours, you can still get in. Chuck at MoneyLifeShow.com. You're guessing the pennies in the Ninja Pig Bank. Take your shot, but while you're at it, Send us picks for Quick and Dirty. Send us your questions, your comments, your suggestions, and more. And right now, we're going to get to the talk because we've got great talk to get to. I told you, it's Scott Brown, then Jeffrey Hirsch, and the book interview, and David Rosenstock talking funds and ETFs in the market call. We're talking technicals when we really get rolling right after this message.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Logic dictates that given their extremely high level of technical development.
Well, it's too technical to explain to the lay mind.
Welcome to Talking Technicals here on Money Life, where we are going to demonstrate that the numbers and the charts and the graphics matter. We're doing that today with Scott Brown. He is founder and chief strategist at Brown Technical Insights, which is online at browninsights.com. Scott Brown, it's great to have you back on Money Life.
Thanks for having me, Chuck. Glad to be here.
We got a lot of things that are kind of weighing on the market. We're near the end of the year, so you've got all of the calendar/seasonal impacts that you might expect, could expect, et cetera. But we've got a market that's wrestling with highs at a time when something that is not necessarily technical, the Fed, is making an announcement. So your base case for how we finish this year right now?
I mean, I think it's got to be higher. It's just 3 weeks, so I don't think we want to make too much of 3 weeks. But we all know that the seasonal tailwinds, the back half of December, that Santa Claus period is really, one of the most bullish stretches of the entire calendar. And we're coming into this setup in an uptrend, seeing a little bit more participation really since the middle of the summer. So I don't think it's the end of the world if we don't deliver, but certainly my bet would be we probably eke out a few more gains and, maybe a new high for the S&P 500 by year end.
But what are we setting up for 2026? I mean, let's get through the seasonal. Let's take the seasonal off. And what happens then?
Let's not take the seasonal off too much because I think that could be a really important story for next year. The first 3 quarters of midterm years are really the weakest of the presidential cycle. In fact, Q2 of year 2 of the presidential cycle, it's by far the worst. And on average, the S&P 500 at the end of Q3, end of September of next year, on average, is down more than 2%. So I think the seasonals are an important part of the story as we, look ahead to a midterm year and the volatility that kind of typically happens in those years.
There are so many extraneous things, so many things we've expected to happen in 2025 that really haven't happened. We thought we'd get more impact out of tariffs than we got. We've seen a number of things that we thought would have bigger impact. And oh, by the way, we're about to have rate cuts, but I don't know of anybody who really thinks they're going to feel like rate cuts normally feel like. So why should we expect normal in terms of, seasonal impacts are normally bad. This is the 3 quarters is bad stuff that we were just talking about.
It's hard to say. We definitely appear to be in a little bit of a transition period. I mean, if we were doing this interview a month ago, we'd probably be talking about weak breadth. We'd be talking about the emergence of more defensive sectors, especially healthcare. But over the past 2 weeks, and part of this ties back to the Fed and, that big shift. And first we thought we weren't going to get a December cut, and now it looks like we will get a cut here on Wednesday. But there's this shift to cyclicality, arguably kind of inflationary pressures if you're just looking at the equity markets. I mean, I'm looking at my screen and what's making new highs over the past week or so. I got banks, I got transports, I've got equally weighted energy, I've got oil services, I've got global materials, I've got steel stocks, I've got copper stocks, and all this is happening while the bond market is sending a similar message and pushing the 30-year yield up to a 3-month high and the 10-year yield on the verge of it. So part of that seemed to tie in well with the Fed 2 weeks ago when we saw the big shift, but we saw even more of it last week, and there wasn't, the Fed fund futures already had that December cut baked in. And so I kind of really wonder if the market's sniffing out something seems to have changed here over the past month. And I think investors should be paying attention to the rotation and what's making new highs right now, not what was leading, 3-4 months ago.
What is support and what is resistance for you? I mean, where are we looking at things where the market will give us a sign that, hey, this is indeed a change?
Like I said, you've got breakouts in all of those. So I think, I'm looking at those cyclical things. Do they keep making new highs? Does KBWB and XLF, does XLF take out 54? Does the Dow Jones Transportation Average, does it keep pushing up above 16,000? Is energy making new highs? So I think that's important for that message. When I'm looking at the index, the S&P 500 is right on the cusp of new highs. 6870 has been where since late October sellers have stepped in and pushed the index lower. So, that's the big level that I'm watching this week. If we pull back, there's support about 100 points below at 6770. But if we break out, the base that this chop that we had in November measures to is about 7190. So, I mean, if we're just purely looking at the S&P 500, there's real upside if we can finally clear this congestion level in the 6870 zone.
And that could be before the end of this year during the seasonal rally, or that's what we're going to see as we get into the new year?
Well, they always say, give them a target, but not a date or one or the other. I don't think you can expect 7190 by year end. I don't think that's realistic. But if we do see that breakout by year end, I think that's going to really seal us for some upside, pushing up to maybe 7,000 or so by year end.
Then that gets us into a year where seasonality kind of wins out for you for the first 9 months. And I know you don't want to necessarily have to go any longer than that, but your base forecast for 2026, another positive year overcoming the problems, a flat year, or at some point seasonality and calendar impacts win out?
I'm not going to be a huge target guy. I don't like to run money like that. But what I'll say is I think it's a pretty safe bet to expect, maybe not we obviously had the April tariff crash, but since then it has been very smooth sailing in a pretty low volatility environment. So I'm going to say that the first half of 2026 probably more volatile than the second half of 2025 has been. But again, I mean, I don't think you want to get bearish when all those incredibly cyclical groups are the ones making new highs. I think I'd start to be concerned, and I was getting a little bit concerned, frankly, in November when it looked like we were seeing this shift towards healthcare, towards staples. But as long as defensives aren't the main thing that's benefiting from this rotation, credit markets are buying in, spreads are back and tightening, I think more gains is possible. It just might be that index gains, the S&P 500 is so growth heavy. What if something like the Dow, what if something like the Russell 2000 is what has more gains than the growth heavy S&P 500?
Well, that being the case, allocation wise, are you changing? Are you shifting? You're looking, for example, more internationally, given that there's better valuations there, things along those lines, or the international game's tougher to play from a technical standpoint, so it holds less interest?
We're pure technicals. My focus is I'm only investing internationally. If you got a strong technical trend and a technical case for outperforming the S&P 500, we've seen that some. I mean, Europe's done really well. Japan tactically looks like it probably needs to consolidate, but it's been really strong. I'm still intrigued by China, so I think there's opportunities to pick your spots internationally, but I really like China here. It's kind of pulled back, consolidated over the past few months, but it is all this chop and consolidation is happening on top of a 3-year base. And so that breakout is still holding. I think that could be another opportunity for outperformance versus some areas of the U.S. in 2026.
Coming back domestically, you talked about how until recently, of course, the big concern was breadth. We've now broadened out at least a little bit. Does that look real to you? I mean, is that, how many times have we had head fakes from small caps, et cetera, that like, never mind, it's not actually the time. No, it's not actually.
Very, very valid, especially with small caps. I'd say the most encouraging thing is at least we're not getting completely rejected from those highs. I mean, the previous trips to like 245 on IWM, we got there and the rejection was swift and hard and fast. Now we're at least battling. We're staying up there, but I think it's a fair point. I'd like to see more new highs. So last Thursday, we got 23.5% of the S&P 500 making a 1-month high. That tied the best reading that we've seen since September. I'd love to get us up to 30% this week to really say that we are seeing a true expansion in breadth, and it's not just one of those head fakes.
The Fed, if you looked at betting markets, and I'm starting to wait to see the betting markets. I've had this conversation with one or two folks when the betting markets are going to become a technical indicator,
People are already using them.
Are they using them well, or they're using them going, hey, this is a new tool. You know, if you gave me a nail gun, having no skills with a nail gun, I'm likely to put one into my foot or my hand. So that doesn't, just because you got a tool doesn't mean that I can use it well. Are they using it well?
You know, I think it depends on the market. I mean, some of those, you know, there's a little poly market or betting market for everything on earth, but some of those things like, you know, will the Fed cut? You got pretty good volume. And so you really do at least have a pretty, I think, good sentiment gauge of, you know, that's why I like technicals. It's don't tell me about what you think or what you're saying. Tell me what you're doing. These people are putting their actual money there. And so I think that there is some validity to it. But again, you want to make sure that you are looking at a market where it's not just one person betting on something.
Well, and so what we've got is a market that is currently betting on the Fed to cut this week. I think that's baked in fully. We don't really know. You know, we missed some numbers there for a little while. The Fed has been flying blind. I don't think that we're going to see anything out of Jerome Powell that we don't expect, which is going to be, oh, let me warn you that I won't be so easy on the next one. But then it's going to become data dependent again, and we'll see what the numbers say. But there's a lot of inklings that maybe with the jobless rates going up, et cetera, that this could be the last cut for a while. He could be a little bit hawkish. If the market's not able to judge the Fed, does that just add volatility, or does that actually put and change pressure? Like, again, we're not expecting a Fed rate cut to have the classic impacts of a rate cut. So how much does it actually matter when we get one or we don't get one?
Yeah, I mean, well, certainly if we didn't get one, that would be a huge surprise, because whether you're looking at the poly markets or you're looking at Fed fund futures, this one's fully baked in. So I think they will deliver. But you're right, the market isn't pricing in the next cut until it's very late April. I think it's April 29th. That's a little while for a market that was throwing a fit here 3 weeks ago about the possibility of not getting a cut. So if it was such a big deal that we were possibly not going to cut here in December, you know, I don't think anybody really believes 25 basis points, you know, just changes the global economy. I do wonder if that could be a problem, because it seems like they are probably going to signal, you know, don't expect another cut coming too soon.
Well, Scott, great stuff. I really appreciate you taking the time to join me. We'll see how it turns out, and we'll talk to you about it again in 2026. Thanks so much for coming on Money Life.
Thanks, Chuck.
That's Scott Brown, Chief Strategist and founder at Brown Technical Insights. Go to browninsights.com to get more information. And speaking of more information, well, we are just getting started. And if you like technical analysis, well, up next, it's the book interview. But it's not just any book, it's the Stock Traders Almanac. We'll be discussing that with Jeffrey Hirsch from the Stock Traders Almanac when we come back. And then it'll be the Market Call, where we'll talk ETFs with David Rosenstock from Wharton Wealth Planning. Stick around, we're living the money life, and there's much more to go.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Did you know that there are at least 23 million American adults who can't read a want ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents.
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The book interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
Well, we can't just start one story. We have to start with a lot of stories, because that is part of what we're doing today as we dig into the Stock Traders Almanac. The new edition, the 2026 edition, is out. And if you want to learn more about it, go to stocktradersalmanac.com, where you can also learn about the Almanac Investor Newsletter. Joining me now to talk about it all, Jeffrey Hirsch. He's editor of Stock Traders Almanac. His father, Yale Hirsch, started Hirsch Holdings, the company that he now runs as chief executive, but also, you know, the Almanac was his thing. So this has been a long-running thing in the Hirsch family, but it's also been a long-running thing for a lot of investors, and you're going to find out why. By the way, we got a couple copies that we'll give away in a contest that will start this week. Jeffrey Hirsch, seems like only a moment ago we were talking on Money Life yesterday. Welcome back.
How you doing?
I'm great. You know, I've had a long love affair about the Stock Traders Almanac. Money Life has been around for for about 13 years. I think you and I have talked about the Almanac almost every year. So it's gotten more play in the book interview than any other book. But I have to ask a question. Almanac is old school technology, and to some extent, they would say old school thinking. It's, here's what happens. It's very much on the calendar effects that we talked about in yesterday's show. But we now live in an AI world. So help somebody understand, in an AI-driven world, why is Stock Traders Almanac for 2026 still relevant?
Behavioral finance. People still behave in very similar ways. Yes, things do change over time a little bit, but people still go to sleep and get up around the same time. They still go on vacation around the same time every year. They still pay their bills around the same time every month. Sure, things are sped up and productivity is increased with AI, but people still have emotions. They're still human beings. They still respond to news the same way, and they still have repetitive behaviors with their money and with their investing. There are times when seasonality does not exist. That means there are other forces that are more powerful, that are overriding them. But generally, there's still a lot of repetitive behavior. And as the old saying goes, that those who fail to remember the past are condemned to repeat it. I like to think that those who understand market history are bound to profit from it. And I think that's what makes the Almanac relevant. That's why it's been around for as long as I have. And that's why it's still on the desks of top money managers and traders and investors. And there's plenty of skeptics, like there's a lot of things, but that's what keeps it going.
I'm curious, in an AI world, because I can't remember which guy said, because I normally don't read much in the way of blurbs on the back of any book. But I have to say, with the Almanac, I'm looking each year because I think I know pretty much everybody that you have. They've all been guests on the show. One of the folks, I think it was Josh Brown, but maybe it was Barry Ritholtz. That's who I think it was. Like, this gives you a chance to sort of get an idea of what the market's going to do every day, a year in advance. But now with the development of AI, you can kind of look and go, hey, how often were we right? How often were we wrong? And those sorts of things. And I'm wondering because, I tell people every day, best thing you can do for your money till we do this again the next day is not worry too much about it. How much, since we're talking about behavioral finance, is this also don't get worked up about the day-to-day because, yeah, when you take it a year ahead, we're not always going to be right, but we're going to be right enough.
Yeah, I mean, unless you're a day trader, you don't need to take it day to day. If you're a day trader, turn to the Almanac and see, where the market tends to bottom and move as it continues to do, as it has for many years. One of some of the first research I did was looking at the intraday patterns for the market. And amazingly, they still persist with the rallies at the close, the weakness around 2:30 Eastern time, of course, New York time. And the problem that we have with AI is the accuracy. So you may think you can go check things, but you've used the different agents or the different platforms enough where you see there are plenty of errors in there. And that's one of the things that we pride ourselves in the Almanac is accuracy. Some of it, people might don't think it matters whether it's right or wrong. But I mean, I've asked ChatGPT about some well-known economic data, and it gave me the wrong data. And I said, "You're wrong. It just came out." And oh, sorry, you're right. I mean, how many times I've been through that? So AI is a tool, but the data that garbage in, garbage out critique is real. Use it, but check it.
One of the things about any almanac, take it out of the realm of the stock traders almanac, put it into the farmer's almanac, where it's telling you, plant your crops here, do those sorts of things. And that was a big part of what almanacs were doing back when they were originally created, is that you are trying to look at things and come up with numbers. So is there a range that the almanac is setting? As we look out into 26, and I've got the 26 almanac in my hands, what the audience wants to know is like, is there a range? Is there a forecast range, if you will, that the almanac has for the year ahead?
Forecast range for 2026? Sure. I thought you were asking about, what level of probability is something that you can bank on, which made me think, we have the market probability numbers on each and every day of the year. And I'll get to what our outlook is for 26 in a second. But, we look at across multiple time frames and we want to see the same pattern over short, long, and medium term time frames, whether it's back to 1950, back to 71, and then the recent 21 years. And also, we're looking for something that happens more than 60% of the time. for there to be an edge. And then we're looking for magnitude. So it's frequency and magnitude over multiple time frames is the kind of patterns that we're looking for. And with respect to 2026, next year, the midterm election year, at first blush, you'll look at the 4-year cycle and realize that the midterm year is still the worst year of the 4-year cycle, where we tend to have bear markets and market weakness like we had in the past. 2022, we had a textbook October 22 midterm year low. We had weakness in 2018. But coming into 26, while our outlook is a little less sanguine than it was for 2025, the reset we had in April on Liberation Day and with the whole, sort of February to April decline kind of felt a little bit like a bear market on some levels. It wasn't an official bear market on the Ned Davis research rules that we use for the stock market as a whole, but it was pretty close, and that may have been a reset. And then drilling down into the midterm election year patterns where you have the second term presidents, second term Republicans as well, those midterm years are stronger than the first. So that kind of puts us to the sort of upper end of the reduced midterm year outlook. I mean, we could be initially in the copy that you have in your hand. I was looking at maybe a 4 to 8% year over year gain with weakness in Q2, Q3, that weak spot. But as we get into the end of the year and formulating our annual forecast in the Almanac Investor newsletter, and everyone's kind of getting negative. They're thinking this bubble's going to pop and it's time. We can't keep going like this. Maybe, the AI boom and the big beautiful bill and the fiscal policy and the Fed lowering rates, maybe the fact that we had that reset in April, maybe we're more at the upper end in the 8 to 12% return, sort of right in line with the average gains, since 1950 for the broad market. I still think we've got some weakness in the middle of the year, the sell in May period, the worst 6 months, the Q2, Q3, but we can probably end up the year in the upper single digits, maybe low double digits once we're, in December of 26.
Well, you were prescient enough to answer what was going to be the second question. I was going to ask for the prediction first and then the probabilities. Well, let's talk a little bit about the probabilities and what happens when the market gets a little crazy, right? Because a year ago, roughly, you and I were talking about the Stock Traders Almanac for 2025. And while you can forecast many things, and you could have said, oh yeah, and we're expecting tariffs, you could not have figured the tariff tantrum at the beginning of April. So what happens to the probability when you get that kind of an outlier? And not so much on the day, obviously, when it happens, that's almost random as for the day it happens. But in the aftermath, when you have a big event like that, how much can you say this is still a reliable forecast? And the numbers still suggest that the probabilities are still reliable.
I think you got to roll in a little technical analysis, a little sentiment analysis. Once we saw the market get back up above those resistance levels and get back onto tracking the pattern, and we were looking at, a post-election year since 1985 being more bullish, being the best year of the 4-year cycle. And once we got back up into that, I mean, you can see some of the charts that we posted out there. It's in the newsletter also on the blog where 2025 starts to track back in there. And then you look at the sentiment, like when the VIX gets above 50, like it did back in April, there's a buy signal right there. I mean, that's something you have to remember and learn to check your motion at the door. When the market sells off like that and the fear indexes, spike, you're looking at an opportunity. And then you wait to confirm that by the market returning back into the historical pattern that gave us that outlook, that gave us those probabilities, as well as some of the technicals, which, even basic, just reaching those levels and getting over the resistance levels and the moving averages were key to confirming that. So that's why we got back in, later in April. It was April 17th we got back in.
And obviously, the Almanac is one piece of work. You're working on the Almanac Investor newsletter all year because you've got years of history to look at. I mean, how often do you wind up sitting here going, okay, I'm making the forecast that I'm going to make the Almanac Investor newsletter as current and as day-to-day as it's going to be. How, do you ever get to the spot where you go, yeah, we're now so off track that the Almanac itself, the annual thing, I don't know where it's going, but I know it's not the direction that I'm forecasting with everything short term.
I wish I could say that it ends up being wrong a lot of times. But if we just stick to what we know and we stick to the system, it really ends up being very helpful moving forward, especially with some of the adjustments we make with more recent history. I mean, if you go back to 1896 when the Dow started, those probabilities and those histories are not going to be relevant. You look post World War II, post 87 crash, you start again with, looking at things over multiple time frames. It kind of helps you. And if back in April you started to forget about the what the almanac was telling us, you ended up being wrong going against it. So stick to the system until proven otherwise, and check your emotions at the door and listen to what history tells us. I mean, as Patrick Henry said, the only way I know of looking in the future is drawing a line from the past through the present.
Well, I have to tell you that for me, this is as close as I get to like when I was a kid and I would buy the annual update to the Guinness Book of World Records and would want to look through the numbers and, what's the whatever that I find. But the other thing that's always a pleasure every year in the almanac is all of the quotes. Now, I know as somebody who we do a quote of the day and we've had thousands of them, I know that there's a lot of art, and then there maybe is like, when did we use this one the last time or what have you? But I got to know, because you are always good at dropping a quote. Like as an interviewer, I know pretty much always that there's going to be something like the Patrick Henry quote that you just dropped or whatever that's going to come into an interview. So I want to know, what's your favorite of the quotes? And then I want to know, what's the quote that you wish everybody knew about or heard that you're like, yeah, but I can only use this like once a year or once every couple of years, that you kind of go, this one encapsulates my favorite quote.
There's a bunch of them. I mean, brevity is the soul of wit, Shakespeare, from Polonius to the King and Queen in Hamlet. One that I'm, leery of using because I found it land on the wrong date, but it's Rothschild, the time to buy is when blood is running in the streets. That ends up on Good Friday. That's one of the things I've learned to be careful with. That's kind of rough. An obscure one coming from my friend Sam Stovall's father, Bob Stovall, the late great, is selling a soybean contract short is worth 2 years at the Harvard Business School, which is kind of nuanced. There's a lot of them there. They, writing a book from Churchill. First it's a mistress, then it's a master, then it's a tyrant. Ritholtz and I have spoken about that one recently since he just put out a nice new book.
Yeah. There's so many in there. I very much appreciate it. We have been known to periodically look and go, okay, yes, we need to freshen up some quotes of the day. Let's go find some that are in there. I appreciate that and all of the rest of it. Like I said, I love the almanac. I know you're going to keep doing it. Can't wait to talk to you again in 2026. Meanwhile, thanks so much for this and for yesterday. I appreciate your time on Money Life.
Thank you, Chuck.
And by the way, the almanac did not predict that in that answer, Sam Stovall was going to come up, because Sam is going to be on Money Life next week. But meanwhile, we've got more to go on today's show. So a quick reminder that Jeffrey Hirsch is the author of the Stock Traders Almanac, or the editor of Stock Traders Almanac. He's the chief executive officer at Hirsch Holdings. You can learn more about everything he does, including the Almanac Investor Newsletter, at stocktradersalmanac.com. Money Life. We'll be right back.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
David Rosenstock, Director of Investments and Financial Planning at Wharton Wealth Planning, is here. We're talking funds and ETFs, and it's time for the market call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening impacting the market, and how they put it all together. And today we are joined by David Rosenstock, the Director of Investments and Financial Planning at Wharton Wealth Planning. And if you know the name of the firm, which you do now, just add .com to it. You'll find their website if you want more information at whartonwealthplanning.com. David Rosenstock, welcome back to Money Life.
Chuck, it's good to be on your podcast again. Thanks for having me.
We always start with methodology, and while folks may have heard you from your last appearance, we're not going to assume anybody remembers that. So let's start with, when you're looking at funds and ETFs, what is it that you're looking for that's going to help you determine your buys and sells? How much of it is fund specific? How much of it is market specific?
Yeah, so there's 4 key elements that we sort of think about. One, the first is we believe simple wins. So we definitely like transparency in the companies we're investing in. So that means we're looking for ETFs and mutual funds that focus on public companies that have to adhere to very strict reporting standards. Broadly speaking, we like to look at both value and growth stocks and build low-cost, tax-efficient portfolios from there as we're looking at the different investments that are out there in the ETF and mutual fund universe. Having the right balance between the growth stock category and the value stock category is critical. In the fixed income category, we evaluate the interest rate environment for fixed income and bond opportunities. We avoid crypto and private investments or alternative investments. And we definitely believe cost matters. We could pass those directly on to a client using low-cost ETFs as well as mutual funds. The second element is we like to take a systematic long-term approach, and we think the investments that we choose must help us do that. So long-term returns are definitely the most important. However, as we all know, investors have to endure the short-term volatility to get there. So in the long run, we believe asset allocation and diversification are going to be the main drivers, and we select our mutual funds and ETFs to help us set up that way. We invest both for income and growth using academically validated principles. We select ETFs for mainly stocks and mutual funds and ETFs mainly for the fixed income categories we invest in. And this also means avoiding short-term trends, which I think is really important to do. Third, from a methodology standpoint, we like to customize our investments to meet the risk profile and goals of the individual. I don't think anybody could invest or should invest a client's money without deeply understanding their risk profile, their time horizon, what their goals are. We think clients are best served by ensuring that their investments are consistent with their specific circumstances, needs, and desires. Contrary to maybe what the popular opinion might be, we don't think the biggest risk is market risk or economic risk. We think that the biggest risk is that the portfolio isn't properly aligned with the owner's goals and needs, and costly mistakes could be avoided by using the correct level of risk. And then last, we're always have an eye on tax efficiency. ETFs could be very tax advantaged products, as well as municipal bonds and municipal bond mutual funds. So we spend a lot of our time when investing thinking about this. And we're also focused on matching the right types of investments with the right types of accounts. Certainly, there are tax advantaged accounts, tax deferred accounts. And so making sure that you're optimizing that, I think, is really important. So it's not just about picking those best investments, but also putting them in the best accounts that they could be in.
As you're talking about risk in there are a whole bunch of new tools when it comes to funds and ETFs, where we're talking about stuff that has options, covered calls, any kind of strategy that's going to try to mitigate risk and maybe make returns more consistent. Do you like those products because they offer you stuff that is different, or do you dislike those products because they offer complications? They're not simple.
That's a great question, and one that I definitely think about a lot and get asked about. And so I think the simple wins philosophy, I think, makes those products unadvantageous to clients. And part of the reason is if you're using options or different strategies, by selling a covered call, which is what some of these funds do, you're capping your upside, and there are costs to these products to minimize volatility and to minimize risk. But I think the costs outweigh the benefit, and you're much better served just using a combination of simple stock ETFs, bond mutual funds, bond ETFs, and sort of managing volatility and downside with that strategy. Because all of a sudden, you're going to drop your expense ratio a good amount. You're not necessarily going to cap your upside with respect to stocks. And I think overall, you'll get a better overall return in that regard, as well as get a better tax efficiency. A lot of these products that might be minimizing volatility could end up costing you on the tax side if they are passing that along to you.
So as you're doing this right now, do you tilt at all towards ETFs because they are the newer product, et cetera? Or is it just about finding the right match and you don't care which vehicle you've got?
In general, I'm definitely a strong believer in finding the best products, and the best products in terms of performance, in terms of tax efficiency, in terms of low cost, they happen to be in the ETF world, in my opinion, and most times in that passive index related strategy world. And so I think that's one of the main reasons I'm sort of open to look at everything, and we do look and evaluate all these new options that are always coming on board in both the mutual fund and the ETF world. But I think the ETFs sort of really are going to give clients the best long-term return prospects. And I think from a diversification standpoint, also, I really like the way the ETFs accomplish that focus.
So as you're doing this now, what stands out to you as kind of a poster child for the methodology, the kind of thing you want to be leaning into at this point?
Yeah. So, I mean, one example is Cohen & Steers. They have something called a low duration preferred and income fund. The ticker is LPXIX. As you can tell from the name, focuses on preferred securities, and those combine characteristics of both stocks and bonds. Preferred securities typically offer higher yields than most fixed income securities. And so the fund's primary investment objective is to provide high current income as well as to preserve capital. What I like about this particular preferred stock fund, and there are several out there, is that this is a good low duration preferred stock fund, meaning that the maturities that the fund is selecting tend to be 3 years or less. And so on the interest rate curve, I don't like long dated securities, whether it's preferred stocks or bonds, because I think with all the volatility that's been out there in the interest rate environment, I think you're much better served by being in the shorter part of the yield curve. You don't have to give up that much return, and you're taking less risk. And I think, this fund currently yields about 5.2%, has a reasonable expense ratio of around 0.6%, holds about 200 preferred stock issues. And the other interesting thing is most of the preferred security market is issued by investment grade companies. And this is important because those are the lowest default companies. So they're the highest credit quality companies. And these securities, in addition to all that, they also offer attractive after-tax yields because qualified dividend income paid by preferred stocks is taxed at a top rate of around 20% versus 37% for traditional sort of taxable bonds. So you can see there's a big difference there and a good tax efficiency there for people that are in higher income tax brackets that are tax sensitive. So that's definitely one that I think is interesting right now.
And we've got time for one more. What's another pick that you particularly like right now?
Yeah, another one I like, we spoke about ETFs, Vanguard Growth Index ETF shares, ticker is VUG. I think it's a good way to, be involved with the AI build out, but not necessarily in a hyper aggressive way. It's a diversified growth ETF. It's very good for long-term investors that are seeking capital appreciation through exposure to large cap growth stocks. Really good track record, low expense ratio, holds a lot of the leading innovative companies, and holds about 180 companies. So you're getting a good diversification in that growth sector. Definitely could be more volatile than the overall market in certain periods of times. But overall, I think, that's an interesting way. And a lot of people are talking about AI. And so this is sort of an interesting way to sort of get some exposure, but maybe not be too aggressive about it.
And what makes you sell once you've got something like this that you like in the portfolio and you've got the bigger theme? What is going to have to change for you to go, I'm going to be out of this fund, not necessarily to something in the same space, but whether it's that or not, what is it ultimately that makes you give up on a fund?
Yeah. So in general, the way we handle our buys and sells is we sort of do rebalancing over time. So our selections tend to be very diversified to begin with. We don't really do heavy focus on specific sectors of the S&P, for example. But in general, as the market might appear a little over its skis, a little frothy, very significant expansion in price to earning ratios of certain companies, or just a little bit over excitement. We might trim back in a way to rebalance there. So we'll sort of sell the ones that we think have sort of gotten a little bit ahead of themselves, and then rebalance into ones that we think are better value and still lower priced. So we're trying to buy low and sell high there. In addition, I think we're always looking at the economy. And so if we feel like unemployment is sort of at a crossroads, and or the Federal Reserve is sort of not sort of doing the things that we want, we might sort of make some adjustments there with respect to fixed income or growth stocks. And we'll sort of make changes in that sort of a global macro fashion.
Well, now we're going to get your quick and dirty take on some ETFs and some funds that my audience is particularly interested in.
Quick and dirty.
Ahead, walk factor 2.
Yeah, we are picking up speed as we've gotten to quick and dirty, our lightning round here with David Rosenstock. He is Director of Investments and Financial Planning at Wharton Wealth Planning. If you want to learn more, whartonwealthplanning.com. Quick and dirty is our lightning round. To get involved yourself, send your name, your hometown, and the ticker symbols you're interested in to Chuck at moneylifeshow.com. We will put them onto our list and hope they make it into an interview soon. Though I will say, it's a lot tougher for funds and ETFs to get off the list because we do fewer interviews that way. So we're going to start with two funds that I know have been on the list for a while. And, I mentioned some of those interesting constructions. Well, Dale in London, Ohio wants to know about the Madison Covered Call and Equity Income Fund. It's ticker MENYX.
That's a fund that prioritizes income and lower volatility over maximum capital appreciation. By selling covered calls, which is what this fund does, the fund is capping its potential upside gains in strong markets like the ones we've been in over the last few years. And that leads to lower overall returns compared to more standard equity ETFs during strong markets. This fund has a pretty high expense ratio, over 1%, and high fees can definitely erode long-term returns. The recent performance metrics, I think, show it's generally lagging even behind its category peers. And I think there's better vehicles to invest in if you're sort of looking for something with a little lower volatility versus this particular fund.
Whoa, dumber than advertised.
The fund makes some promises to you, and it's not that it hasn't delivered, it's just that it hasn't delivered as well as you could do in another fund. That's an avoid or a sell on MENYX, the Madison Covered Call and Equity Income Fund. Al in Orchard Park, New York wants to know about the Alpha-Centric Income Opportunities Fund, IOFIX.
I don't particularly like this fund. The strategy involves investing in subprime residential mortgages that are seasoned. So these are mortgages that were originated before the financial crisis, so in the 2007 timeframe or earlier. By investing in these lower rated junk tranches, low credit quality, it makes it more volatile than its peers. Its longer term performance hasn't been particularly great versus peers. I think over a 5-year period, it's delivered negative annualized returns, while some of its peers have seen more positive returns that are not only focused on that subprime area. And then in general, the high expense ratio as well really could eat into erode those longer term returns. And so that's also another point to be thinking about.
So you might like the idea of investing in real estate and homes.
There's no place like home.
But it's not nearly so good if you get there and find out there's no soup for you on IOFIX. That's the Alpha-Centric Income Opportunities Fund. That's a sell or an avoid. Let's move over to ETFs. We'll start with the riskier ones and then move a little bit safer. Javier in Wilmington, North Carolina wants to know about WCLD, the Wisdom Tree Cloud Computing Fund.
This is a thematic fund. Those types of funds in general, they could be subject to hype. And so this fund did particularly well during COVID, when there was that work from home spike and everybody was sort of doing everything from home. And so this ETF it's mainly comprised of small and mid caps, which haven't done nearly as well as large caps over the last few years. But in general, I think WCLD, it misses some of the larger, more dominant cloud providers. like Google, Microsoft, Amazon, even though it is a cloud computing fund. And I think that's a big negative and has been a big negative to performance. It hasn't benefited much from the artificial intelligence build out over the last few years, which is not a good thing. And so overall, I would definitely rate this one a sell. I think you're better off just investing, if you want to be in mid caps, or just investing in a more diversified mid cap ETF, or if you want to be focused on cloud, I think you're better off focused on a larger fund that's going to also encompass some of those larger cloud companies that I just mentioned. So I would rate this one not a buy.
So a fund that's supposed to be on cloud computing that misses some of the biggest names and has got some other issues.
Sell crazy someplace else. We're all stocked up here.
Yeah, we're not buying that one. That's WCLD, Wisdom Tree Cloud Computing. Sean in Grinnell, Iowa, and Tony in Henderson, Nevada both want to know about VYM, Vanguard High Dividend Yield.
VYM is definitely a buy. I like it. It's a good investment for those seeking stable income and risk mitigation. So we spoke before about Madison covered call and equity income. And so I like this one as a sort of a substitute, even though it is definitely different. It doesn't have a covered call strategy. It is seeking stable income and risk mitigation, which is a good strategy for people that are a little bit more conservative, and has a good diversified portfolio of stocks. It's definitely not the best choice if you want to maximize growth, but it does have an ultra low expense ratio of about 0.06% and dividend yield of around 2.5 or 2.8%. That's higher than the S&P average. And then with over 500 holdings across various sectors, you're getting really good diversified broad exposure. And I think it's particularly well suited as a core holding for people that are near retirement or even in retirement looking to live off dividends without necessarily having to sell shares. But again, if your primary goal is maximizing long-term growth, then you might want to make this one a smaller percentage of what you're investing in and focus elsewhere. But I like this one a lot.
Good quality fund. Just make sure it's serving the right purpose in your portfolio.
That's why we should buy now.
And yeah, that would be why you would want to buy now. And last, again for Sean in Grinnell, Iowa, it's Mint, the PIMCO Enhanced Short Maturity Active ETF.
Mint is definitely a buy as long as it fits your needs. It's basically a good cash plus or short-term holding for income generation and stability in your portfolio. So it's definitely not huge growth. It's not going to give you as much appreciation as some bond funds that are out there that have longer maturities because it is very short duration. But it offers decent yield, around 4.07%, low volatility. And so if your goal is to invest cash for better than savings account returns with little risk, MINT could be a good fit. And also if interest rates decline over the next few years, which is what the current thought process is, I think this one is still going to benefit from that, even though it is fairly short dated. So I think, you just really want to understand, if you don't want to be in this, if you don't want to be super, super conservative, because it's not going to give you the long-term horizon returns that a lot of other opportunities might be able to give you. But I like this one as an alternative even to CDs in my mindset. I think it's good. It lets you go in and out, has a good track record.
And so we finish on a high note. Again, it's got to be the right thing for the job. But if it is,
I'm in this for the long haul.
You'd be in for the long haul on Mint, the PIMCO Enhanced Short Maturity Active ETF. And you could be in the long haul for that. But we are at the end of the road when it comes to our time with David Rosenstock. But David, this has been great. Thank you so much for joining me on Money Life.
Always a pleasure being on the podcast, Joe.
That's David Rosenstock, the Director of Investments and Financial Planning at Wharton Wealth Planning. Go to whartonwealthplanning.com for more information. We'll come back. We'll wrap up this show. We'll tell you a little bit about what's coming tomorrow and more. So stick with us all the way till the end. You don't want to stop short.
Hey there, Money Lifers, it's Rob Floyd, the show's executive producer and contest master. And we have our first ever contest this week with visual clues. Check our social media this week and you'll find 2 pictures of Chuck's penny bank, the bank he uses to hold pennies only. It's stuffed with money to the point that it weighs 21.8 pounds. Check the pictures. You can send us an email asking for copies or just take a guess on how many pennies are in the bank. And you'll be entered into a drawing to win Your Future Is Now, Your Blueprint for Solving Your Retirement Puzzle by Jeffrey Panic, featured on December 2nd. Face Your Financial Fears, The Simple Guide to Fixing Your Relationship with Money by Jake Cousineau from the December 1st show, or The Sustainable Investor from Peter Kroll, which was discussed on the show November 17th. Send your name, address, your priority list for the books if you win, and of course, your guess at how many pennies are in the bank to chuck@moneylifeshow.com by 5 p.m. Eastern Time on Tuesday, December 9th to be entered for the books. Good luck.
Thanks so much for sticking with me till the end. Appreciate that. We've got a couple things to wrap up on this show. We also are wrapping up a contest. Now, I did say we will have copies of the Stock Traders Almanac to give away. That will be in our next contest, which will start tomorrow, right after we tell you the winners of this one. And it's been very interesting. Lots and lots of guesses on the amount of money in the bank. And the bank in this case being the Ninja Pig Bank. I will tell you that, yes, I have actually counted it. So I now know the numbers, and I'll give them to you tomorrow when we announce the winners. But you have a little bit more today here on December the 9th to get in on that. And then, yes, we will start a new contest for the Stock Traders Almanac when we announce the winner on this one tomorrow. Speaking of tomorrow's show, Ben McMillan, Chief Investment Officer at IDX Advisors, will be here tomorrow. And we will have Nick Rach, Chief Executive Officer of the Earnings Scout, who has not been on the show for quite some time. He'll be back doing the market call with us. So we've got all that and more. So I hope you will be here with us too tomorrow. Meanwhile, if you're looking for something to celebrate, well, it is National Llama Day. I will simply point out that I can't even say the word llama and think about a celebration without recognizing that my grandson, too early for us to be reading books, etc., to him. I'll be very curious to see how much different he sounds when I am back with him next week. But one of my kids' favorite books was Is Your Mama a Llama? It was all done in rhyme, etc. And I probably could recite most of it, but I'm not going to bore you with it. But I'm just saying, if you're looking to celebrate National Llama Day, that one for small children. It's Christmas card day. I guess that means that you're supposed to be sending them out, if nothing else. It is Weary Willie Day. Weary Willie was a sad hobo clown played by Emmett Kelly, who was kind of the king of the clowns. Emmett Kelly was born on this day in 1898. And then on the food front, well, I don't actually know that I would consider this food, but it is Lutefisk Day.
Yuck, what reeks?
Yeah, lutefisk is this fish thing that they eat in places like Norway. And I wholeheartedly encourage you to go find the column that Dave Barry once wrote when the Olympics were in Norway and he was trying lutefisk. But no, thank you. It is one of the most disgusting things I've ever seen put on a plate, let alone had to smell or try to taste. No, not doing it. Not celebrating it, only celebrate how awful it is. It is also National Opal Apples Day, a specific type of apple. If you can use them on your pastry, that'd be good because it's National Pastry Day. My guests today were Scott Brown, Chief Strategist at Brown Technical Insights, online at browninsights.com. Jeffrey Hirsch from the Stock Traders Almanac, stocktradersalmanac.com. And David Rosenstock, Director of Investments and Financial Planning at Wharton Wealth Planning, which is online at whartonwealthplanning.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Ken Hubbard, who said, "Nothing's as mean as giving a little child something useful for Christmas." Well, yeah, but that's the kind of mean I grew up with because, of course, I didn't really grow up too much with Christmas. But I'm good for that kind of mean because I think you want to find things with meaning. And if you're finding those things with meaning, you should keep money in perspective. And remember, until we do this again the next time, the best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Go home, you losers!